Disney beat estimates in its first quarter, and most of the profits came from the Parks and Cruises unit, led by Josh D'Amaro, who is set to succeed the current CEO, Bob Iger, later this year. Let's get more from Ken Leon, Director of Research and Global Fundamental Research at CFRA. Thank you very much indeed for joining us.
Great to be here.
What jumped out for you with the Disney quarter and the forecast from the company?
Well, it's the beginning of a new fiscal year, and it's one where we really didn't see all businesses firing on all cylinders. It's also a transition year, as noted, with a change of management. All that leaves investors, I think, a little bit questioning execution risk here. We certainly did see some improvement in operating income, particularly in the streaming business, Disney Plus. But overall, there's lots of puts and takes. Disney with sports segment, with ESPN, it's a tremendous franchise to have. But the sports right cost of getting major leagues has added to expenses and put some pressure on operating income. So I think in total here for Disney, it's how do you get all the different businesses moving in the same direction so that we have a strong quarter. That was not the case with the first quarter just reported.
Can you remind me, are investors still worried about streaming and the enormous investment there and the risk that it won't produce returns?
Well, they are. And you just can't drive subscriber growth without really having a good business and generating positive operating income. It's interesting. Disney has followed Netflix and not really disclosing subscribers anymore. And they just point to nearly a doubling of operating income in the quarter versus a year ago, and getting those margins up to about 8.5%. So that's pretty good. There's more work to be done there. But also, Disney provided less information related to, they have a legacy business, which is the broadcast network business. And that showed, again, a single-digit decline in advertising. So the pivot is happening, and Disney, of course, has to really orchestrate strong improvement in the streaming business because the networks business is still declining.
And it was interesting that the foreign visitors, lots of Canadians, are skipping America as a destination right now for their travels, and that is not great for the parks business.
Well, you're right. It's not only coming to the domestic parks, but its attendance has been not as strong as expected. Even in Florida with Disney World, for average Americans to take their family to the parks for 1 or 2 days has gotten too expensive. Mm-hmm. And I think that has impacted the ability of getting stronger revenue growth, but also as they have large capital investments. So, you raise a good question, because really the strategy and North Star, if you will, for Disney is the theme parks, and they expect to spend $60 billion over the next 10 years. Wow. With new venues and improvements. And then, of course, outside the U.S., the image of the U.S., and Disney is strong, but you watch how they do in markets like Shanghai or in Europe and Paris and anywhere else. These become issues.
The longer term, would you be a holder of Disney? I mean, at one time this was a stock, well, that may be going back more than a decade. People thought, well, Disney, that belongs in every portfolio.
Yeah, so, as investors, we look at Disney in terms of when could they have attractive returns on invested capital and the ability to generate not only higher profitability, but return of capital. Disney did buy back $2 billion of stock in this quarter reported versus about 740 million a year ago. But to your point, if this is going to be a core holding in the communication services sector, which is critical for the U.S. equity market, they're going to have to execute better. And when you look at the valuation and target prices you put on a stock like this by over 30 analysts covering this stock, looking at the last year or two is slower growth or not having execution across the businesses. So that's a show me story, and one where I think whether it's institutions looking at mutual funds or individual investors, you want to see more visibility of really consistent performance.